Okay, chapter 7. Chapter 7 kind of brings together everything we've been doing. So when I say brings together, we've done our trial balance. We could do the extended trial balance. We'll come back to that. But our aim is to get to these two financial statements, which are derived. I mean, again, just takes us back to the very beginning. A plus E plus D is equal to C plus L plus I. That's kind of the origin of all of this. We're just discussing this thing, the accounting equation. We're just showing it in a nice, neat format that everyone can use. And so my aim is to sort of do I minus E, right? Because I'm looking for profit. That I minus E is what we call the statement of profit or loss. And then once I do I minus E, forgive me, you get your profits, you add those profits back onto C, right? And once I add those profits onto C, then I'm now in the sort of, I kind of rearrange this again, and I then have really I take L onto the other side, A minus L is equal to C plus my profits, of course, minus D, right? And this is what we refer to as a statement of financial position. That's fundamentally what we're looking at here. Okay, let's carry on. So let's look at I minus E first. So the way I minus E is formally laid out, I mean, again, I is just revenue, right? So we have revenue, and we say revenue minus what we call cost of sales. Now, cost of sales is your opening inventory plus your purchases minus your closing inventory. Now, this is an example of the accruals concept. I'm just going to do a quick example. This is probably the most important thing of the video. I mean, the rest is just the layout. So when we do this, I'm just doing a quick example here. Say, for example, you have A plus E. I want you to always look at this conceptually to see what's going on. Say, for example, you buy goods worth £10,000 on credit. £10,000. And let's just say that you sell those goods. I'm going to change my pen color here. You sell those goods. You sell some of those goods. So you sell half of the goods for £8,000. Half of these goods you sell for £8,000. £8,000 here. And then you have asset. Let's just say the money comes into the bank. These are actually irrelevant. My focus is on the I and E. The question is, what is profit? What is I minus E? Is I minus E 8,000 minus 10,000 or 8,000 minus 5,000? So this is our definition of profit. Profit is really how much have you made on what you sold. You sold £5,000 worth of goods. So what do? Well, if I want to be able to compare, if I want to compare correctly the I minus, or let's just, so that this is clearer, let's say you sold £6,000 worth of goods. Well, if I'm trying to get £6,000 worth of goods, how we do it is we take away what you didn't sell. And what you didn't sell is referred to as the closing inventory. You purchased, if you like, 10,000. So in this scenario, you'd have 10,000 for purchases, and we pay what you didn't sell. You didn't sell £4,000 worth of goods. Those goods are still yours. They, if you like, into your warehouse for the night as assets. You will sell them in the morning as opening inventory. So for now, what we have is 10,000 minus 4,000. And this 10,000 minus 4,000 is 6,000, which means that my revenue, of course, being 8,000, allows me to see a profit clearly of, right? So this is what's behind this idea of cost of sales. So the very next day, when I start my day, I'm going to move back. I'm just going to go down a little. I'm going to move this 4,000. Let's say we end this here. The very next day, this 4,000 is going to come out of here and go back into my kind of goods ready for sale again. Then I'll buy some more. Say I buy another 3,000. So now I have £7,000, which is why you see I have £7,000 worth of goods ready for sale. That's why we have opening inventory plus purchases. Then, say for example, I get rid of another 6,000. So if I get rid of 6,000, it means that I have, I'm going to change my pen color, £1,000 worth of goods that will go back into my warehouse. That's my closing inventory. So this defines this idea of opening inventory plus purchases minus closing inventory. So you can see, please turn to page 161 of your textbook. Make sure you're looking at that. You can pause this while you look at that. Page 161, and then come back straight away once you've paused it. So you can see on page 161, you have revenue, you have cost of sales, and then you have what's referred to as gross profit. Gross profit is the profit you have made purely from the sale of the product. Right? Purely from the sale of the product. And there are reasons for this. You want to sort of know if the product itself is actually worth selling. Then we take off all the overheads. We take off all the overheads, right? All those light and heat and water and all those general things that just, if you like, call these indirect fixed costs, if you like. Indirect fixed costs, we'll talk about, you'll do a lot of this when you do costing. Indirect cost, fixed cost. Here we're talking about kind of direct costs, variable costs. Right? So we take all those away, and then we have what this is referred to as your net profit. Once upon a time, we used to call this bit over here the trading account. We used to call it the trading account. You can see why. It's just to do with trade. What's going on from the actual trade. Here we're dealing with all these other things that aren't to do with trade. But, I mean, they're necessary expenses. So you can see that we have that. And this is really fundamentally I minus E, right? Isn't it? We're just having two different types of E's. If you like, we have kind of your direct E's and your non-direct E's. But ultimately, it's I minus E to give us profit, which we go on and add on to capital. If you flick onto the next page, you now have the statement of financial position. And all we're doing again is classifying our assets and liabilities. We're just laying them out. We're just kind of sort of classifying the ones that are long-term and the ones that aren't. So we have non-current assets and we have current assets. I mean, they're all A's, but these ones are long-term, right? Buildings, machinery, factory. We have all those here. Then we have our current assets, classic current assets, the closing inventory you didn't sell, your trade receivables, and your cash at bank, for example, bank and all those things, and cash, if you like, other receivables. So these are all A's, right? And then underneath, you can see that you have your let's just go down here. You have your L's, and then you have your current liabilities here, right? Then you have your current liabilities, and we'll talk when you have trade payables, if you like. So you have A minus L. Then let's look at the other L. Then you have, if you like, your long-term liabilities. So we're just breaking down these different assets and liabilities. So we can just for understanding and classification. So here we have your non-current liabilities as well. Here it says I'm on page 163, 12% loan. And then pretty much we have A minus L. We kind of find what A minus L is, and that gives us what we call our net assets. So we use it as a way of, as a control, as a way of checking to see whether we're still doing the right thing in terms of, is the equation still balancing. So if we use it as I say, a control. So if A minus L, we can find the answer, and we can also find separately what's going on with our kind of what's going on this side. So if we see, oh, we know what the opening capital is, we add on our profits for the year, net profits, we take off our drawings, so we get an answer as well. So I guess you can call this closing capital, right? Because you had opening capital, added on, took out drawings, added on profit, or added profit, took off drawings, you have closing capital. We expect the two to be the same, which is why you hear accountants saying things like, oh, my balance sheet or my statement of financial position has balance. Right, great stuff. So that's the first part of this video. Oh, sorry, it's a bit long. 7 minutes. We'll do the next part, which is more to do with ethics. See you in the next part of this video.